All right, let's get right into it. Are you looking to scale your business across borders, but honestly feeling a bit overwhelmed by the whole European tax landscape? Trust me, you are absolutely not alone. Today, in this explainer, we're going to demystify how entrepreneurs can effectively navigate European taxes. Our goal is to help you scale your international operations without handing over all your hard-earned revenue. Okay, let's dive into this. Are high VAT rates and overlapping international taxes silently eating away at your profit margins? Because when you're expanding into Europe, the absolute biggest mistake business owners make is just ignoring the structural tax design. If you don't plan ahead, you might literally end up paying taxes twice on the exact same income. No way you want that.
So, here's our strategic roadmap. First up, the European tax landscape. Then, we'll break down corporate tax versus VAT. After that, we'll cover exactly how to avoid double taxation, followed by a real-world optimization example using Estonia, and we'll wrap up by looking at some highly profitable jurisdictions in Eastern Europe.
Section 1. The European tax landscape, a continent of contrasts. While the European Union actively standardizes certain policies, especially around trade, individual member states retain total authority over their own corporate and income tax rates, and that creates massive regional differences.
These differences are absolutely stark. Just imagine you generate a cool €1,000,000 in net profit. In a high-tax jurisdiction like Germany, your corporate tax can reach up to roughly 33%. That takes a huge bite out of that million. But base those exact same operations in Hungary, and you pay an incredibly business-friendly 9%. Or Bulgaria, which sits right next door, with a flat 10%. Understanding these numbers is literally step one in choosing a profitable base for your operations.
Moving to Section 2, corporate tax versus VAT, and knowing your liabilities. We really need to clearly define the two major tax liabilities that every single international business must manage.
So, the crucial point is understanding the fundamental difference here. Corporate tax targets your success. It's what's levied on your company's net profits. VAT, on the other hand, is a consumption tax placed on goods and services. So, for example, if you sell a software subscription to a consumer, VAT is added to the price that your customer pays, and that's highly regulated by EU directives. Corporate tax is what you pay on the profit you have left over at the end of the year after all your expenses are paid. Basically, one taxes the transaction, and the other taxes your final profit.
Now, dealing with cross-border VAT used to be a complete nightmare. But enter the EU One-Stop Shop, or OSS. It is a centralized system that lets businesses register for VAT in just one member state. So say your business is based in the Netherlands. You just use that single registration to declare and pay VAT for sales made to customers in France, Italy, or literally anywhere else in the EU. It's a massive, game-changing administrative time saver.
Section 3. Smart structuring and how to avoid double taxation. Because being taxed twice on the exact same cross-border income, that is the biggest threat to your international expansion.
Let's move to and see how this builds into a strategy to protect your revenue. Step 1 is determining your tax residency. This is usually triggered if you spend 183 days in a country or if you establish your center of vital interest there. Step 2 is applying the relevant EU double tax treaty. For example, if you personally live and are a tax resident in Spain, but your software company is based in Germany, the treaty prevents both countries from taxing your dividend income at full price. And finally, step 3 is claiming your tax relief. This legally unlocks reduced withholding taxes on those cross-border payments so you actually keep more of what you earn.
All right, Section 4, optimization example, focusing on the Estonian OU. Let's look at a really powerful real-world setup that is absolutely huge for IT, consulting, and SaaS companies.
0%. Seriously, zero. Estonia features an incredibly unique corporate tax system where the tax rate on reinvested and undistributed profits is exactly zero. You only pay a 20% corporate tax when you actually distribute those profits as dividends. If you leave the money in the company to fuel your growth, buy new servers, or hire more developers, it grows completely tax-free.
To ground this theory in reality, let's look at a quote from a Ukrainian SaaS founder who actually made the leap. They told us, "We were tired of currency control and PayPal rejections." By setting up an entity in Estonia, they completely escaped rigid local banking controls. They easily opened accounts with European fintechs like Wise or Stripe and just seamlessly accessed the broader European market.
And this brilliantly illustrates how straightforward the process actually is. Here's the Estonia playbook. First, obtain your e-residency. Keep in mind this is a digital identity, not tax residency. Second, register your OU online with as little as €1 in minimum capital. Yes, €1. Third, enjoy a 0% VAT rate on B2B IT services that you export outside of Estonia.
And finally, automate your entire accounting process using specialized software like Zolo or OneOffice. You can literally run a fully compliant European business from a laptop, sitting at a cafe anywhere in the world.
Section 5. Profitable jurisdictions in Eastern Europe. While Estonia is fantastic for reinvestment, Eastern Europe offers a whole variety of other highly beneficial setups.
The contrast in effective income tax rates here is genuinely eye-opening. While standard progressive income taxes in Western Europe can reach up to 45 or even 50%, specific regional tech regimes give you a massive competitive advantage. In Poland, an IT professional operating as a sole trader can access a flat rate of just 12%. Over in the Czech Republic, certain trade license setups result in an effective tax rate of around 7% for incomes up to 75,000 euros. And down in Portugal, under the non-habitual resident status, you can lock in a flat 20% rate. Choosing the right regional regime is a massive win for your bottom line.
But beyond just choosing a good jurisdiction, you really need active strategies. Here are some specific actionable ways to reduce tax for SMEs across the EU. First, invest in tax-efficient assets like green technology to unlock specific state credits. Next, maximize your research and development deductions. Countries like Ireland and Poland heavily incentivize innovation. You can also strategically defer income or accelerate your expenses to manage your taxable base, which improves your immediate cash flow. And lastly, adopt modern tax management software. Remember, meticulous compliance actually unlocks your savings.
Which brings us to our final provocative question. Is your current business structure serving your growth, or is it just feeding the tax authorities? I really hope this explainer inspires you to audit your own cross-border setup. With the right knowledge about corporate rates, VAT rules, and double tax treaties, you can take immediate action toward a much smarter, highly profitable European expansion. Thanks so much for joining us and learning today.